Look, most traders think crude oil moves just because of random news headlines. But professionals, they know something much deeper is happening underneath. We're talking about supply, liquidity, geopolitics, and massive institutional positioning. Welcome to this explainer on the underlying mechanics of one of the world's most powerful financial markets.
Literally every single day, trillions of dollars change hands in the oil market. Trillions! Yet most retail traders approach oil completely blind to what's actually driving price behavior. You know the type. They react to the news, trying to catch a falling knife, or they chase some sudden spike because of a tweet. Well, we need to completely shatter that retail illusion today. Oil markets do not move randomly. As you can see from the core philosophy we're discussing, true price action is driven by highly systematic institutional forces.
Behind every single retail spike or sudden crash you see on the charts, global banks and mega hedge funds are actively maneuvering. They are shifting global liquidity and hedging major macro risks. Because in this market, the ultimate prize is liquidity. When you actually understand how smart money positions itself around this asset, you stop guessing, you stop gambling, and you start understanding the deep underlying currents that are really moving the charts.
So here is our roadmap for today's explainer. First, the institutional market. Second, trade mechanics. Third, true price drivers. Fourth, Brent versus WTI. Fifth, liquidity timing. And finally, number 6, the disciplined transition. We are going to move from high-level market mechanics right down to disciplined, safe retail execution. Let's dive in.
Okay, Section 1, the institutional market. Why smart money trades oil.
To really get this, you have to understand exactly who is playing the game. Crude oil isn't just fuel for your car, it is literally the lifeblood of the entire global economy. Because its price swings ripple through everything, manufacturing, logistics, tech, the biggest players in the world are absolutely forced to participate. You've got massive energy companies hedging their production risks, you've got hedge funds executing huge macro plays, and global banks managing complex energy portfolios. Now, what retail traders usually fear is volatility, right? But oil's inherent consistent volatility is only viewed as a risk if you're unprepared. For the institutions, it acts like a powerful magnet. They are actively seeking those precise, highly liquid opportunities.
Moving right along to Section 2, trade mechanics, from physical delivery to CFDs. If you want to stop being prey in this market, you absolutely have to understand the actual instruments used to tap into oil liquidity. There are 3 main pathways here. Step 1 is spot trading. This is for immediate, physical delivery, and it's pretty much exclusively used by massive energy conglomerates and institutional players. Step 2 is oil futures. These are standardized contracts locking in a future price, heavily utilized by funds for speculation and hedging. And then we have Step 3, CFDs, or contracts for difference. Look, while institutions totally dominate the physical and futures markets, CFDs are what allow retail traders to participate seamlessly in price swings. And the best part, you don't ever have to take physical delivery of a single barrel of oil. It is by far the most accessible format for retail traders to interact with this massive liquidity pool.
All right, Section 3, true price drivers. What smart money monitors? Let me be incredibly clear. Professionals do not chase the news. Instead, they monitor 5 core catalysts that actively reshape liquidity expectations. First up, supply and demand dynamics. This is the fundamental, everyday balance that impacts the market. Second, geopolitical events. Because massive oil reserves sit in highly sensitive regions, military conflicts or sanctions create sudden, severe swings. Think about that massive 30% surge we saw right at the onset of the 2022 Russia-Ukraine conflict. Third, OPEC decisions. These cartel announcements happen every few months and they drastically shift output expectations. Fourth, economic indicators. We're talking GDP growth, non-farm payrolls, and weekly EIA reports. Institutional traders track these exact macro catalysts to anticipate exactly where the volume is going to flow next.
And the 5th absolutely critical driver, the US dollar inverse correlation. Because crude oil is priced globally in US dollars, there is a direct mechanical relationship here. A stronger dollar makes oil much more expensive for buyers holding other currencies, which suppresses global demand and pushes prices down. Conversely, a weaker dollar makes oil relatively cheaper overseas, which supports prices. Smart money relies heavily on this inverse relationship. They use it as a vital confirmation signal before ever positioning themselves in the market.
Let's jump to Section 4, Brent versus WTI, choosing your liquidity pool.
You have to realize, not all oil is the same. Institutions actually structure their strategies around 2 very distinct global benchmarks. On one hand, we have Brent crude, often listed on your platforms as UK oil. Originating in the North Sea, this acts as the global benchmark for about 60 to 70% of all traded oil. It is incredibly sensitive to international macro news and geopolitics. On the other hand, we have WTI crude, or US oil, originating in Texas and Oklahoma. This is the American benchmark. You must align your strategy with the correct asset, guys. Brent reacts to global events, while WTI liquidity is heavily driven by domestic US data, especially those weekly EIA inventory reports.
Moving into Section 5, Liquidity Timing, when volatility expands. Listen, timing is quite literally everything. Trading during dead zones? That's a classic retail trap. Professionals sit on their hands and wait for specific liquidity windows where heavy institutional volume steps in. Take a look at 1 p.m. GMT, that's the Europe-US session overlap. This brings a massive surge in volume. Then at 2:30 p.m. GMT, the US session opens up, representing the absolute most liquid window of the day. You also want to pay special attention to Wednesdays at 2:30 p.m. GMT for the EIA crude oil inventory report. Volatility and volume expand drastically during these fundamental events, as well as during monthly releases like NFP or OPEC announcements. This is exactly when smart money is most active.
And finally, Section 6, the disciplined transition, a systematic approach.
Okay, so now that we actually understand the institutional mechanics, let's look at how a retail trader can safely enter this arena. And spoiler alert, it requires ironclad risk management. Without a professional mindset and extremely strict risk control, inexperienced traders simply become exit liquidity for larger funds. You absolutely have to protect your capital with everything you have.
To avoid becoming someone else's exit liquidity, you need a systematic onboarding sequence. Step 1. Build foundational market knowledge. That's exactly what we're doing together today. Step 2. Choose a regulated, trustworthy broker. Step 3. Practice strictly on a demo account. Step 4. Refine a strategy that actually produces consistent, replicable results. And finally, Step 5. Transition to a live account with rigid position sizing and mandatory stop losses. I can't stress this enough. This structured sequence is non-negotiable. Building muscle memory in a risk-free demo environment is absolutely essential before you ever risk real capital in the live markets.
The stark reality of the market is crystal clear when you look at it like this. The unprepared trader skips the demo completely, comes in wildly overleveraged, uses zero stop loss, and faces a very early, painful capital wipeout. They're just trading on raw emotion. But on the flip side, the well-prepared trader studies the macro fundamentals, practices for months on a demo account, uses strict stop losses to completely control their risk to reward, and scales their position sizes slowly. The contrast is night and day. Those seeking quick, easy profits almost always fail, while those who adopt a disciplined, systematic framework, they are the ones who achieve sustainable growth.
So the overarching truth of the institutional market really boils down to this. Oil trading powerfully rewards deep preparation, rigorous structure, and disciplined understanding. Ultimately, your success in the oil markets has nothing to do with luck or catching some random, flashy headline. It is entirely about your preparation and your respect for the massive liquidity forces that actually drive price.
When you are genuinely ready to apply these concepts and begin your transition, remember that your environment matters immensely. Utilizing a highly regulated broker with a massive educational ecosystem like FXTM ensures you actually have the proper infrastructure behind you. They provide the multi-regulated security, the essential demo accounts, and all the analytical tools necessary to support your systematic development into a confident professional crude oil trader.
I want to leave you with one final provocative thought today. Are you ready to stop reacting to the retail noise and start trading alongside the underlying liquidity? The market is waiting for you. It does not care about your feelings, but it heavily rewards preparation. Approach it with knowledge, structure, and a true institutional mindset. Thank you so much for joining me on this explainer. Keep learning, stay incredibly disciplined, and I will see you in the next one.